Hello and welcome to this Friday's morning market briefing. We've got lots to talk about, but firstly, Blackstone warns that private equity cannot return capital overnight, as well as that Iran warns of shift in nuclear stance if Israel threatens atomic sites. We've got lots to talk about on the charts, also with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure to subscribe. The first article to talk about is to do with private equity. Now, Blackstone has now warned that it will take some time for private equity firms to return cash, and this comes as private equity firms are sitting on record amounts of unsold assets, despite the market for mergers and acquisitions somewhat coming back to life. Now, of course, we've been covering issues relating to private equity extensively recently, with a great deal of issues currently facing the private equity industry, not only on the front of getting rid of those assets, selling those assets, but also finding new capital and allowing current capital within the firm, current investments and investors within the firm to basically exit in any way possible. And I think the first article that we really spoke about in regards to this issue was on that topic of enabling new capital to flow into these private equity firms, with these firms such as Blackstone now utilizing new lending strategies and new selling strategies and that kind of thing, to basically enable current investors within let's say Blackstone to exit and sell off their share within the private equity firm to another person, which maybe wants to get involved in the company, but ultimately they're not able to do it at this current time based on the way that interest rates and that kind of thing are, because obviously interest rates are at their kind of all-time highs at the moment, and that's forcing these private equity firms to be in a position where they're having to hold on to their assets. They're not able to sell those assets, and therefore those investors which might want to exit the firm aren't able to exit in the traditional route of maybe an asset being sold, an investment being sold, and with that the capital is returned to the investor, and the investor can leave the private equity firm. That's not being done because these sales aren't taking place, and so as a result a secondaries market has kind of formed, where new private equity investors are basically buying the share that the old investor has within the private equity firm. So these are the kind of new strategies which are being developed, and that's kind of what we spoke about last time. But ultimately, the situation for private equity has become more optimistic, really, ending off last year and starting off this year, as ultimately, as I've said many times, investors were expecting interest rate cuts, maybe even beginning as early as March this year, from the Fed, as we were seeing US inflation levels kind of fall dramatically, and we were seeing certain economic data from the US which was hinting towards those early rate cuts. Of course, though, if you've been following the markets recently or watching these morning market briefings recently, you'll of course know that kind of perspective has now changed dramatically, with the Fed now being expected to make their first rate cut sometime in September, which of course is far later than previously expected. And even after, say, that rate cut does take place, investors are kind of only expecting 0.25 percentage point rate cut for the entire year. So investors aren't even expecting the usual or the what the Fed expected at the start of the year, which was 0.25 percentage point rate cuts this year. So certainly the private equity industry is now having to deal with that as well, because ultimately these firms such as Blackstone were expecting these lower rates to end off the year, and therefore they were expecting these usual asset exit strategies to kind of return to private equity, such as IPOs and other mergers and acquisition strategies. But ultimately that won't be possible still, because should interest rates only start to come down in the second half of this year, that's still forcing these firms such as Blackstone to hold on to those investments that they want to get rid of for much longer. So, that is the current situation facing these firms. And ultimately, adding on to that, we are seeing these kind of growing geopolitical tensions. Of course, we've highlighted many times now the issue within the Middle East regarding Israel and Iran. We're still expecting Israel's response to those Iranian strikes last weekend, and therefore, should something like that take place, should a strike on Iran take place by Israel, we could definitely see a large fallout from that, and possibly even a regional conflict, which of course would risk a great deal of the world's oil supply from Saudi Arabia and others within the region, which of course creates that inflation shock, which so many of these kind of central bank leaders have been warning of. So that's the kind of issue which is also facing these firms, as ultimately that uncertainty also means that whilst we may be expecting rate cuts in September just based on the current inflation figures and the current projections, ultimately these geopolitical risks always mean that basically rates could stay where they are for a very long time should these kind of conflicts come to fruition. So that's another thing that's of course important to know regarding private equity and this kind of industry as a whole. With Blackstone now expecting a rebound in deal making as financial markets begin their first IPOs after 2 years of silence being the case as a result of higher interest rates. It is private equity firms such as Blackstone which expect that falling interest rates will enable an increase in deal making, which will facilitate the exit of $3 trillion worth of unsold investments. That said, whilst private equity firms hope this will happen, ultimately strong US economic data and growing tensions within the Middle East has pushed back rate cut expectations, and therefore and the Fed expecting persistent inflation, firms may be forced to hold on to their assets that they are looking to exit from. Blackstone, despite this, have remained optimistic and now expect markets to shrug off the later than expected rate cutting cycle, with an expectation of better economic data in the future being the basis of that hope. Blackstone is in an interesting spot investment wise, having doubled the amount of investments they have made from $25 billion from $11 billion a year ago, but they've only been able to sell just $15 billion in investments, which is a decline from Q1 of 2023. So, a very significant problem facing these private equity firms still, such as Blackstone, and it'll be interesting to see how these firms now do kind of cope with these higher interest rates, which are likely going to stay around for much longer than previously expected. But obviously here we're hearing from Blackstone, which expect these higher interest rates to actually not affect the markets in the way that they've done so far. So lots to think about there in the topic of private equity. Next to talk about though is to do with Iran. Now, as I in the last article highlighted, there is large geopolitical risks within the Middle East at the moment, which could boil over into becoming a regional war, which of course threatens not only the world's oil supply, but also just world peace in general. And of course, this will have large ramifications on the markets. And this is of course a topic which we've been covering extensively with regards to Israel and their conduct in other conflicts as well. Now, Iran has now warned the world that should Israel strike any Iranian nuclear facilities, the Iranian regime may review their own nuclear weapons stance. This comes as both the US and UK have announced new sanctions on Iran following the Iranian drone and missile attack on Israel. Now, of course, we've covered these heightened tensions within the Middle East for some time now, and of course ever since the October the 7th attack and massacre by Hamas, we've of course followed Israel's operation then into the Gaza Strip, and the current fight that's going on in there between the IDF and Hamas, of course. And so that's obviously been adding to world tensions, with of course Hezbollah in the north around the Lebanon border, of course always being at risk of engaging in a full-scale conflict with Israel. And of course we know that within Syria, the Damascus regime is of course always kind of on the kind of level on the kind of at this stage where any conflict could of course always break out within the Golan Heights, basically. So there's always the risk of that. And with this Iranian strike now into Israel for the very first time, now we're expecting Israel to of course strike back, which creates that risk, prompts that risk of a regional war breaking out within the Middle East, with of course we know Saudi Arabia is against the Iranian regime, and we know of course that Israel has been for a very long time as well. We know that certain nations such as Syria and Iraq have also begun to align themselves more so with the Iranian regime as well. So there's definitely that potential for a regional conflict to break out should Israel strike Iran in retaliation, as we do know that Iran has vowed also to increase the kind of the level of attacks that they will then launch on Israel should Israel strike them. So we're kind of on the fence now at the moment of a serious regional war, and this is definitely something that we need to keep our eyes on, with the Iranian Revolutionary Guards declaring that they may need to reconsider their nuclear policy should any strikes on such atomic facilities take place. Iran is currently bound to a non-proliferation treaty regarding uranium enrichment and nuclear weapons. However, heightened tensions with the West could cause this to change. The Iranian regime also warned that any attacks on Iranian nuclear facilities would be mirrored against Israel's nuclear weapons sites. Despite these comments, Israel has already pledged to respond to the Iranian drone attack, with this stoking fears in Israel's Western allies, who have now announced new sanctions on 16 individuals, and 2 companies which help produce Iranian drones. Israeli Prime Minister Benjamin Netanyahu, however, has not changed his rhetoric and vowed that Israel will do anything necessary to defend themselves. So this is a very serious topic, of course, with very serious ramifications should anything take place. So you should definitely keep your eyes on that, and it's something that we'll come back to when we're looking at both gold and oil and even the dollar, really. So all of that is affecting markets as well. Next to talk about though is of course the charts, after covering all of the articles there, and we are kind of starting off once again as usual on the US 30, talking about US indices as a whole. And of course the US 30 and other US indices over recent weeks, well actually more so over the last week or two, have kind of been in this bearish period now, this bearish trend and push, with price pushing to the downside after of course the Fed chair Jerome Powell changed his rhetoric regarding monetary policy, with him moving from that more kind of dovish stance that we heard around the end of last year and start of this year, and now it's become one which is far more hawkish, and that is why we are now expecting the Fed to kind of cut interest rates last out of the central banks of the Bank of England and the ECB, of course, and so that's been weighing on the markets as investors have started to price in those higher interest rates, as we do know, as I said earlier, that investors are now only expecting one rate cut from the Fed this year, which is a dramatic change from what investors were expecting at the start of the year, which was 6 to 7 interest rate cuts. So that is why we are now seeing this retracement, and this retracement, to be fair, came at a time where markets were very overbought, and price had been inflated quite significantly, with price seemingly rallying and never having a significant enough retracement. And it does seem like now we're seeing that retracement take place. And prior to Jerome Powell's speech, of course, that kind of strong US economic data was what started this kind of decline, and then Jerome Powell added to that, and that's why we are at this level just now. Now, of course, price did retrace starting off this week and did react to that 38.2% Fibonacci retracement level, where price has then sold off. But for now, within the past 2 days of price action, price has really not found its swing to the upside or downside, and instead just ranged around consolidated. And it's likely that it's likely that we won't see anything now until the start of next week. But certainly going into next week, price is at an interesting level for things to come. So definitely keep your eyes on the US 30, and I think price will be affected ultimately by the geopolitical situation at hand as well. Next to talk about though is the dollar, which of course, as a result of the more hawkish rhetoric from Jerome Powell, as well as the geopolitical risks at the moment regarding Israel and Iran, the dollar has moved in a very bullish fashion to the upside, with price pushing to those levels not seen, of course, since November of last year, when the Fed's rhetoric was, of course, very dovish, very hawkish, pardon me. That said, because we have not seen an Israeli strike yet back against Iran, in my opinion, that is why we have now seen kind of the decline in the US indexes kind of slowed down, as well as the dollar actually kind of retracing a bit, because ultimately, we were expecting an Israeli kind of retaliation at the start of this week. And I think as that time does get drawn out, we're less likely to see a great deal of bullish support for the dollar. So that's something that I think is important to keep on your mind. Of course, we haven't had much dollar data this week, more so British and Eurozone data. Arguably, that's also why we haven't seen too significant moves. That said, over the past 2 days, price has retraced on the dollar and has now reacted to that 50% Fibonacci retracement level, and is now pushing away from that level to the upside. So still interesting opportunities on the dollar. Next to talk about is Euro USD, which mirroring the dollar's price action. Price has had this great deal of bearish momentum recently, driven by the Fed's rhetoric and the ECB's rhetoric, which has been far more dovish, and as a result, price has pushed it downside. That said, price then did retrace after becoming overbought, as shown on the oversold on the RSI, and since then, price has now reacted to that 50% Fibonacci retracement level and is now seemingly continuing now off down to the downside, with that level of minus 27.2% on the Fibonacci retracement, Fibonacci extension level being the next target to look at for price. Next to talk about is pound yen. Not much can be said on pound yen, despite for the past few months, past few weeks, pound yen kind of reacting in a very clean fashion to these key liquidity zones, to these key Fibonacci levels. Ultimately, over the past week, price has kind of consolidated and ranged around, and we haven't seen many moves take place. And you can just highlight that by just going like this. You can clearly see that this is just a period of lower volatility, or arguably high volatility but a lack of direction within the markets, and so as a result we're not seeing price move one way or another. It's unlikely that anything will change ending off the week, but definitely going into next week we've got lots of things to keep our eyes on with regards to price possibly breaking above and moving to those all-time highs once again. Next to talk about though is Bitcoin, which has been very bearish recently, but as other US assets have started to kind of retrace on themselves from the retracement, the Bitcoin has seemingly done that yesterday, with price now kind of moving back to the upside in an attempt to kind of reclaim those older levels after price made its way all the way down to that $60,000 Bitcoin mark, which of course was a very significant level, and a level which previously had acted as a strong area of support, and that's why we have kind of seen that reaction from that level now. Next to talk about though is gold, which is kind of struggling now to break higher. Arguably that's also because Israel has not yet retaliated against Iran, and as a result that kind of safe haven asset utility that gold provides has not fully kicked in yet, as price waits for such action to take place before it's likely that gold will then continue that move higher. So lots to think about on gold. And finally, and with regards to geopolitics, we are talking about oil, which has sold off from this area of consolidation and ranging, with markets now seemingly pricing in less of a chance that Israel will retaliate against Iran. It does seem like following those sanctions being announced by both the UK and US on the Iranian regime, it does seem like markets are now pricing in no strike back from Israel against Iran. So possibly that means that oil is becoming now kind of undervalued, but at the same time we have to factor in the likelihood of a retaliation. That's what we'll talk about in the charts though. Lastly to talk about, of course, is the economic calendar. We're getting some very important data today, but not lots of it. So firstly, we'll be getting the Japanese inflation rate figure, followed by the British retail sales figure, and then the Spanish balance of trade figure and consumer confidence figure. Across the pond though, not across the pond just yet, but we will have numerous Bank of England official speeches. And lastly, to end off the week, we are having one Fed official do a speech as well. So still lots to listen out for and lots to look out for, but we've covered lots in the articles, lots in the charts, and lots in the economic calendar. Hope you have a great trading day and enjoy your weekend. See you later. Bye. I won't be here for next week. Bye.